On the program today, Egypt inaugurates the Middle East's first wastewater treatment plant. And Uganda ships a maiden fuel cargo from Kisumu port. And in Nigeria, price of plantains fall by 40% in December. Hello and welcome to Business Incorporated. I'm Will Ibong. As always, let's check in on the market, starting with Africa, where sentiments were positive at intraday. South Africa was the biggest gainer here, up by 1.5%. Nigeria's NGX gained 0.32%. Elsewhere, we see Egypt trading 1.01% at intraday, while Nairobi Securities Exchange closed Friday's trading also in positive territory. Now we move over to the Middle East, where sentiments were mostly positive at intraday. We saw the Abu Dhabi index trading 0.33% up, while Dubai was down 0.06%. Now still within the region, Saudi Arabia was up 0.74%, and the Qatari index was also up 0.75%. Now we see in Europe, women are earning less than men in all advanced economies, not just Europe, with experts saying that at the current rate, it will take 257 years to close the global gender pay gap. Up until now, much of the research has suggested that the main reason for the difference is that women generally tend to work in lower paid professions. But a recent study by the scientific journal Nature Human Behavior has questioned that assumption. To talk more about this, I'm joined by Kate Ferguson from Deutsche Welle in Berlin. Kate, what were the main findings of this study?
Was groundbreaking in a number of ways, actually. First of all, researchers looked at a total of 15 countries, and these included major economies like Germany, the US, Canada, Japan, and South Korea. They also had access to a huge amount of data, and this included workers' contracts, as well as things like social security databases. And what the researchers found was that within all of these countries, the fact that women tend to work in lower paid sectors than men accounted for only around half of the gender pay gap. And this means that the rest of the gap in pay has to do with the fact that men and women earning different salaries for doing the same work. And this really contradicts older research, which maintained that you could effectively eliminate the gender pay gap if you take into account the difference between the industries in which men and women work. So what we can really say from this is that it implies that more needs to be done to close the pay gap within companies. And that could mean increasing transparency about pay negotiation and structures, as well as looking more closely at hiring and promotion. It is important to remember, though, that men still do tend to work in better paid professions than women. This study doesn't dispute that, but it does find that explanation is only part of the reason for the gender pay gap.
Be more specific here now. What is the situation in Germany when it comes to the gender pay gap?
So Germany actually has one of the highest gender pay gaps in the European Union. And this research found that on average, women earn 79 euros for every 100 euros earned by a man. And when you remove the fact that women and men work in different sectors, you're left with what's called the within job gap. Here, the study found that even in the same jobs, women in Germany earn around 87 euros for every 100 euros paid to men. This might surprise you, given that Germany does have some very progressive policies, especially when it comes to parental leave. So mothers and fathers here get 14 months paid leave, and they can divide that time however they like. Despite that policy, though, fathers choose to take far less time off than mothers do. And this suggests that societal factors are playing a major role still. Even within a progressive system, attitudes towards gender roles remain firmly entrenched. Changing this could mean putting a conversation about the gender childcare gap on the same pedestal as one about the gender pay gap. Or maybe you could encourage more fathers to stay at home to look after their children. That could go some way towards reducing the imbalance.
We're looking forward to when there's parity in terms of pay, Kate. Now, what are European investors focusing on today?
European investors are still digesting those comments by the International Monetary Fund, expecting half of the EU economy and a third of the global economy to enter a recession this year. But they've also been watching some interesting jobs data that came out on Monday, showing that the Eurozone labour market is faring okay, actually, especially Germany, where the number of people employed is at a record high, and that is due in large part to an increase in foreign workers. More than 2 in 5 German businesses is actually reporting a shortage of workers, and that trend is being seen right across the Eurozone. And while this is, of course, generally good news, for investors, a strong labour market is also a concern, because it means that it's more likely that the European Central Bank will continue to increase interest rates, making it more expensive to borrow money to invest. Raising interest rates does make a recession more likely, but as long as the labour market is strong, central bankers will be more inclined to take that risk. So investors will also be very keen to get those Eurozone inflation numbers that are due out at the end of the week.
Thanks, Kate, for the updates. Always good to have you. Now to the UK, where manufacturing in the country ended 2022 on a weak footing, with production, new orders and employment all falling at faster rates. Juliana is in London with more insights into this. Happy New Year, Juliana. Manufacturers probably are not having a good year, but are kicking off 2023 with uncertainty as December shows a slowdown in a fifth month of contraction. What is making projections, what's making forecasts a bit difficult for them?
New Year to you too. Not so much of a good start to the year for the manufacturing sector, although this S&P global data that was released this morning isn't having a look at January, of course, because we've just started the year. This is reflecting back on December, and it does show that unfortunately the woes of Brexit past are still haunting the manufacturing sector, which contributes about 10% to the British economy. So is quite significant. I think they already had a little bit of trouble before the global pandemic because British manufacturers have found it difficult to compete with much more cheaper, shall we say, manufacturers abroad. But then, of course, we've divorced from our biggest trading partner, and it is causing headache, as the data does reveal. Now, what you said is true. This is the 5th consecutive month that we have seen a fall in output from the manufacturing sector. It fell, I believe, from about 46.5 in November to 45.3 in December. And let's bear in mind that any figure below 50 does indicate a contraction in that industry. And, looking through the survey, most business owners are all citing the same issues. They're having shipping delays, custom bureaucracy at the border. Lots of their former European Union clients are finding it just way too complicated, quite frankly, to deal with the Brits. So they're looking for producers elsewhere. So it's not great. And as I said, this is just the start of the PMI season. So we will be getting a further forensic look later in the week for construction and services, which of course contribute much greater inputs to the UK economy. And the fact that we already are believed to be in a recession, it's not looking great if those numbers are going to be as negative as economists forecast.
I'm seeing, trying to look here, especially with the strikes that are ongoing in the UK. I'm hoping there's not going to be a huge supply chain, maybe disruption in terms of moving goods from one place to another, and that's also going to spike, cost of goods in the country. And Juliana, it's not a good time, especially for manufacturers. And I'm looking at the consumers as well, how much more they're going to pay for these services and these goods that they need to consume. So how are markets looking at intraday?
Well, surprise, surprise, the FTSE has kicked off the new trading week, the new trading year, very much in the green. And this has been helped by retail. Aldi, which is a German discount retailer in the UK. They've just published their December Christmas numbers, and they're pretty positive. Sales were up 26%, I believe, for the first time. They've broken a 1.4 billion sales record for the UK and Ireland. And that's good because, of course, lots of economists look towards retail in the month of January because it's just past that lucrative festive season. So fingers crossed will be getting more positive updates from retailers, particularly Next, which has weathered the COVID storm in the UK. They'll be releasing their trading update tomorrow. So that resurgence in Aldi has lifted other retailers, including Tesco and Sainsbury's, at intraday. The all share is up by more than triple-digit figures. It's up by 2%. The FTSE 100, that's up by 2.05%. In the FTSE 250, the domestic market, that's up by 1.88%. The British pound is not faring too well against the US dollar. I think investors there have been spooked by that pretty placid data we received from S&P Global about manufacturing. The currencies market, the British pound is currently trading 1.14% down against the US dollar, trading up, though, against the euro by 0.11%, but the British pound is down against the Japanese yen by 1.15% at intraday, Will.
Good news for the equities market, kicking off the first trading day in 2023 on a very good footing, but not so good for the for the currencies market. You said they're probably spooked by the report from the S&P 500 Global. We hope that there'll be like a flip or rebound in that segment, and hopefully the market moves on smoothly. Thanks so much, Juliana. Now to other markets in Asia, where trading was mixed to commence the first trading week for the year. In Australia, the S&P ASX 200 fell 1.31% to 6,946 points on its first trading session of 2023. We saw South Korea's Kospi also falling 0.31%. Hong Kong's Hang Seng Index traded 1.84 higher, however, in its final hour of trade, leading gains in the region, while the Shanghai Composite in mainland rose 0.88%. Now, stock futures rose on Tuesdays in the U.S. as Wall Street tried to start the new year on a strong note. Traders are also braced themselves for a flurry of economic data coming this week. Futures tied to the Dow Jones Industrial Average jumped 300 points. The S&P 500 futures gained almost 1%, and Nasdaq 100 futures climbed 1.06%. The major averages closed 2022 with their worst annual losses since 2008, snapping a 3-year winning streak. The Dow ended the year down about 8.8% and 10.3% off its 52-week high. The S&P 500 lost 19.4% for the year and sits more than 20% below its record high. The tech-heavy Nasdaq tumbled 33.1% last year. Now, oil prices held in a narrow range on Tuesday, though the outlook for demand was clouded by a weak manufacturing activity survey from China and a warning from the head of the International Monetary Fund that the global economy faced a tough year ahead. Brent crude futures recovered from their early weakness when prices fell by $1 a barrel, rebounding to $86.29 a barrel, an increase of 38 cents, while U.S. West Texas Intermediate crude was at $80.77 a barrel, up by 51 cents. Meanwhile, oil prices had settled more than 2% higher on Friday, with Brent and WTI ending 2022 up 10.5% and 6.7% on a year before. Now, gold prices hit a 6-month high on Tuesday in thin trading, with the market's attention turning to minutes from the U.S. Federal Reserve's last policy meeting due this week. Spot gold was up 0.8% at $1,838.69 per ounce as of gold futures rose 1% to close, and minutes from the Fed's December policy meeting are due on Wednesday, which could offer hints on the central bank's tightening path. According to experts, the dollar and yield movements will be a key focus for the gold market, as the de-dollarization seen by several central banks last year when a record amount of gold was bought looks set to continue. Spot silver rose 1.1% to $24.25. Platinum gained 0.8% and palladium was down 0.1%. After the break, updates from the commodities market space. Next, this is Business Incorporated. To stay with us. Welcome back. Now, plantain is a nutritious Nigerian delicacy. It can be consumed boiled, fried, or roasted. It's also used in the production of chips and flour. Plantain is produced mainly in the south-south region of the country. Despite the increase in transportation costs, the price of plantain fell by 40% to 1,500 naira per bunch in December from 2,500 per bunch in November. And joining me to discuss this falling price is Oluwatomi Maiwa, Senior Analyst, Financial Derivatives Company. Good afternoon, Maiwa. It's good to have you on the program.
Good afternoon, Bill. Thank you for having me.
Yes. What is responsible, Maiwa, for this decline in the price of plantains? We do know this is a hot cake for most Nigerians.
Thank you very much once again. Actually, it is actually true that the price or the transportation cost has actually increased significantly, and that's coming from the fuel scarcity. And as a result of that, we should see higher food prices as a result of that, especially in time where in the festive period where there's usually high demand. And so, but it's the other way around because why are we saying this? Because of, real income is actually declining because of the constant increase in food prices, which, we know where inflation is currently. And so real income is actually declining, and people are their confidence is actually deteriorating, and so they can only buy less with the money they have with them. And so as a result of that, suppliers, or should I say sellers, are forced to bring down their prices in order to encourage buyers. And I would say that it was a bearish Christmas after all for many people. They were not able to buy the same amount they could buy as at the last festive period in 2021. And so we saw that that trend in the market, especially in December. So where we should see high demand, we saw lower demand. And that's one of the reasons why that decline is there. Another reason is because we are currently in the we are currently in the harvest period for plantain. It spans through November to around February. And as a result of that, there will be increased supply, which will also help in keeping prices. So that's why we're seeing that decline.
Plantains, as we know, have close substitutes like yam and potato, and we know that these prices, this makes it vulnerable to price change and volatility. But we see that yam and potato the prices have remained flat. Yam has remained at 2,000, potatoes probably at 8,000 a basket for some time now. Now, if this, do you think this will boost the demand for plantains, seeing that the prices of their substitutes have been flat for some time?
Yes, that we call that cross elasticity effect because it's in a situation whereby the increase in the price of a particular commodity leads to an increase in the price of a substitute or a closer substitute to that commodity, and an increase in the demand for that substitute. That's what we call cross elasticity effect. And as a result of that, because plantain can also be used, can be boiled like yam, can be roasted like yam, and like potato, and also can be grind into flour. All of those, it makes it a closer substitute to yam and potato. And also considering the health benefit it has, it's good, it's high in fiber, and it helps to reduce blood pressure. So people would actually shift to plantain in order to, because of that decline in the price of plantain. So yes, we would see that that shift. Demand would definitely increase also.
So, according to Food and Agriculture Organization, that's FAO, Nigeria is the world's fourth largest producer of plantains, with an annual production of about 2.8 million metric tons. But we only see a small amount of this going to the production process or to process flour. Now, what can be done to actually, what's hobbling or what's hindering the production of processed plantains in Nigeria?
First, I would like to say that for goods that have closer substitute, it's all actually there's always low incentive to produce such goods because it's usually it can change. It's usually vulnerable to price changes, and so there's low incentive. But aside from that, there's still that supply demand gap in terms of plantain flour, and so there are still few industry in that sector. And why we have that, the major reason is because of their lack of access to finance and they find it very difficult to access finance. And the machines they use in processing this plantain actually they are quite expensive, and it's not easy for them to acquire them except they have that huge amount of capital. And so that has actually limited them from going into that business. So it becomes it's quite discouraging to go into the business. Another reason is the irregular supply of plantain. Like I mentioned earlier on, before that, it's usually harvested during the end of the year to the beginning of the year, and that's where we see low price of plantain. And so the supply is always high at that moment. But towards the middle of the year, you see less of the supply of plantain, and so that would actually affect that supply. So it's always difficult to get more at that moment. And then we also have it's also the transportation costs are actually higher currently. So to transport them from where they are harvested to where they are processed, has been quite difficult. So what should be done actually is that there should be increased access to finance. These people should find it easy to borrow with less interest those loans. I know I'm saying this in a time where the CBN is actually raising interest rates, right?
Yeah.
But in terms of the federal government, we know that they recently amended the 2022 finance bill, where they actually increased tax. So that money they generate from that can be actually moved to low performing industries like this, like what you've mentioned now. So I think that will actually help.
Thank you so much, Myra. I know you've got a lot to tell us about this, and probably we'll have more avenue to discuss this in at length. Now, Oluwatomi Myra, Senior Analyst, Financial Derivatives Company, thank you so much for sharing your insights with us. Now to other stories. Egypt has inaugurated the first smart wastewater treatment plant in Egypt and the Middle East. The plant aims to solve the wastewater problems associated with drilling oil wells for the facilities that drain in the Gulf of Suez, as well as the state's efforts to conserve resources and protect the environment. A joint project of Ministry of Environment and Petroleum Resources, the station is designed to using modern technology that relies on advanced triple treatments, which includes physical, chemical, and biological treatments. The station, with a capacity of 1,000 cubic meters per day, is being implemented at a cost of more than $8 million. Now, Uganda shipped its maiden fuel cargo from the port of Kisumu last month, bringing a spark to the Lake Victoria port that has been positioning itself as a major gateway into the East African region. The 4.5 million liters of fuel ferried aboard Mount Kabaka Mutebi II marked the revival of the water transport corridor between the two neighbors and boost Kenya's efforts of creating jobs in the western region. Uganda's decision to start ferrying fuel from the port of Kisumu is also key to Kenya's efforts of beating Tanzania in the race to be the major entry point for fuel products into East Africa. And that's it on Business Incorporated. I'm Willie Bong. Thanks for watching. Bye for now.